Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining me for another one of our Sunday live streams. Usually Beer Money Sunday, but I'm getting to the gym after this, so I think water's probably a better choice. But you grab whatever your favorite beverage is, adult or otherwise, and thank you for being here. Again, I love doing these every Sunday. Actually took a last Sunday off, spent the weekend in San Andres, a little bit of island life with the family, and great reset. But I get itchy. I get itchy when I don't have the market to analyze every day and to talk to you, all you out there in the Bowtie Nation on Sundays. So it's great to be back. Great to be back with you here for another one of our live streams. And an excellent topic for you today. We're going to talk about 5 strategies for how to invest in stocks in really any market. 5 investing rules, ways to invest that can really set you on that path, and whether stocks are expensive or cheap. And I think this is so important because so many investing rules you hear about are just so vague. Buy when others are selling, or buy low, sell high, that kind of thing. Absolutely helps you in no way in actual investing. So we're going to share 5 strategies with you, and then we're going to have the Q&A later. See a lot of great people here in the Bowtie Nation, here in the chat from Belgium, Russia, Columbus, Ohio, Toronto, Springfield, or Palm Springs, California. Welcome. Thank you everybody for being here. Again, this is just a great way for me to connect with all you out there, a little bit more personal and conversational than what we get in the video. So I love doing these every Sunday. So we're going to get started on those ways to invest. I do want to personally invite everyone to sign up for the Daily Bowtie. It's our free market newsletter. It goes out every night before the market opens, 9 p.m. So it'll go out tonight at 9 p.m. Gives you enough time to figure out what's happening in the market and plan your next trading day. Includes all the important news, information, really the trends and the strategies that a lot of stuff that we show in the videos, but only 3 times a week. This is 5 times a week going to go out to you, and it's absolutely free. It's something I've been wanting to do for a long time. Just started it this year. There's already 11,000 people getting this every night. Getting that news and that information. So I've actually pinned the link in the chat there if you want to click through and sign up, or I'll put it in the description below as well. Just click through, sign up. Again, it's absolutely free. I'll never ask you to pay for this. Just something I always like doing for everyone out there in the community. So I want to get started here. Just a real quick housekeeping. Last week's videos had a really good video on Friday about fintech growth stocks. And this is probably my favorite theme right now, these digital wallets, okay? And actually got something in the newsletter tonight going out about that and about why these are such an opportunity. And it's part of our ARK Invest Big Ideas series, right? Because if you've been following that series, a couple of weeks ago, ARK Invest, Kathy Wood and the team over there at ARK sent out this Big Ideas report. And I can actually show you that real quick here because I've got it saved to my desktop. That's how great this research report was. And you can see it's pretty long. It's 112 pages. And they go through the 15 big ideas ARK Invest, the analysts there, are following. And these are these huge universal forces that are changing the way we live our lives through deep learning, so AI, artificial intelligence, digital wallets, which is that fintech idea that we covered Friday, electric vehicles, of course, automation, delivery drones, space, orbital aerospace. I'm going to be covering in a video in a couple of weeks here. And some great research there, but the problem is they really don't talk about which stocks to buy in each theme. They talk about each theme, the upside potential and some of the research, but they don't mention any stock names, right? So what I'm doing with this series is 15 videos over the next couple of months talking about each of these themes and then picking the top 5 stocks within each theme to buy. So check out that video, Friday's video on fintech growth stocks, some really big opportunities there in that. Next week's videos, I got it coming tomorrow, a video on e-commerce stocks, so kind of the future of shopping. And another really big theme, obviously, e-commerce is nothing new. It's had that 10 plus years of momentum behind it, but the pandemic really supercharged this. In fact, I share some research in that video tomorrow about how the growth in just the last year in e-commerce, right? All the people going online to shopping that had never done so before was like 10 years worth of growth all in 1 year. So it really supercharged that trend for e-commerce and some of the stocks that we'll be talking about. Also going to cover a video on Friday for you, 7 legit strategies to get rich. Anybody that's on YouTube for long enough, you see these strategies, these get rich quick strategies that leave just enough out that makes it basically just not possible for most people. So what I wanted to do was take some of these strategies, actually fill in the detail, give you 2 ways to do this. One is kind of a quick and risky way with 3 strategies in that, and one is maybe a little bit longer term, building up those assets, that passive income that's going to make you rich over a little bit longer period. So that's what we've got coming this next week. Now I want to jump right into that. Into the topic for the week, because it's such an important topic to have, an actual investing plan, right? You're at no loss for investing rules, right? Investing strategies that are kind of vague. And, here's one of my favorites, the Oracle of Omaha himself. And I'm just as guilty of repeating this as well. But, that idea of be fearful when others are greedy and greedy when others are fearful, right? You're supposed to, when others are greedy and pushing stocks higher to all-time highs, you're supposed to be fearful. You're supposed to start getting out of the market and not buying expensive stocks. And then, of course, when people are fearful, sending stocks down, crashing, you're supposed to be greedy, go into the market, pick up those shares at discounts. And that's how you make money, right? Well, of course, the problem with that is that it's just so vague. Greed can last for years, and you can miss out on a lot of that return. And then that part of being greedy, that bravery, when others are fearful, is really only easy in hindsight, right? A great example of this is just over the last 10 years that we've seen in the market. So if you look at the market over the last 10 years, this is a chart of the S&P 500, so that broader index, the market was clearly greedy and stocks were expensive after a decade-long bull run up to about 3,200 at the beginning of 2020. So right at the beginning of the last year, before the pandemic, the market was clearly greedy. Stocks were expensive on any historical basis. So selling, being fearful when others were greedy in that instance, would have basically been lucky that you missed out on the fastest sell-off in history, right? Who would have known that the pandemic was going to come and wipe out stocks? It had nothing to do with other people being greedy or stocks being expensive. It was a global pandemic. But then when people talk about being greedy when others are fearful, right? So if you sold out and you just happened to get lucky, and then you're looking for your entry point. You're looking for when to get back into stocks when others are fearful. And we had the March 23rd bottom in the S&P 500 right around 2,500. But was that really a good time to get back into the market? How did you know that this was like maximum fear of everybody, right? We were still facing down the worst pandemic in 100 years. We were facing down a potential depression on a complete shutdown of the economy. So no one would have guessed that the market was going to be rising again in less than a month. Basically, sold off February 19th to March 23rd was the extent of that 35% drop in stocks, and then it really only took the market probably about 2 more months to it took 5 months for the market to retouch those previous highs. Okay, so the economy was still largely shut down. We were still getting tens of thousands of COVID cases a day, and the market zoomed back higher within 5 months, which is generally it takes right around 8 months, 8 months to 18 months, I think it is, for the market to retake its prior highs after a trough. So the problem with trying to follow this advice, right? Trying to take this rule of being greedy when others are fearful and fearful as when others are greedy, is that there's no set points when you can say, okay, the market's fearful, I need to start buying, or the market's greedy, I need to start selling. If you look at this chart, I mean, you could have said people were the market was greedy all the way back to 2012, 2015. I mean, by 2015, the S&P was at 2,000, right? Market bottomed right around 700 in 2009, March of 2009. Market actually, intraday bottom at 666, which was kind of a bad omen there. But then the daily close, I think, was right around 700. So by 2015, the market was already up, almost threefold. Almost threefold, 300% since that 2009 low. So the market was clearly greedy. It had already made it back. But then if you would have sold out at that point, thinking that stocks were expensive, you would have missed out on another 50% gain. The market was up to 3,000 by 2020. You would have missed out on a 50% gain. So, this idea of knowing when the market is fearful and knowing when it's greedy, a little bit easier said than done, right? The other investing rule is just buy low and sell high, right? Which I've always got to laugh when someone, when someone says that it's quite as easy as that, because again, what's low and what's high. So what you need to do, you need to follow some practical investing strategies, and that's really what I want to talk about today. These 5 strategies that you can use. Some of them work in combination with others. Some of them are a little bit easier, a little bit more stress-free, but all of them are going to give you actual, practical advice, practical ways to invest in stocks that don't involve a lot of guesswork, don't involve a lot of the guesswork and the analysis that goes into trying to figure out if the market's greedy or fearful at any one point. Okay, so the first one is probably the easiest and probably the most disappointing as far as an investing strategy, but stick around for those other ones. But this first one is just regular monthly investing. And what I'm going to be talking about here in a lot of these is finding those great companies that you want to follow for the next 10 or 20 years, right? So you watch maybe a video like we did Friday on those fintech stocks, right? And I firmly believe, Square and PayPal are just going to take the financial world by the leash over the next 10 years, with a lot of the research that we shared in that, these digital wallets and how everyone is going to be going online to do all their finances, all their banking, and all that, and how they're going to be able to use that. So you pick great companies that you think you could be in for 10 or 20 years, and then just invest every single month in them. Okay, whether it's $100, whether it's $500 or $1,000 each month. Everybody is always asking me, how much should I invest? How much should I start with investing? And really, it doesn't matter how much you start with. It's just that regular, constant monthly deposit into your investing account and buying investments, right? I shared in a video about a month ago or so, kind of our simple strategy for investing, that if you were to invest $5,000 all at once, and just nothing after that, which is quite a bit more than a lot of people can just start investing with. But investing just $200 a month, starting from zero, investing just $200 a month will beat that $5,000 lump sum investment over the next 10 years, right? So you don't need to start with a lot. What's important is just every month you put in what you can, try to stick with a budget that you can maintain. And while this is probably the most boring of the 5 strategies that we'll talk about, it's probably kind of the best for a lot of investors, right? Because if you're buying into each of these stocks in your portfolio every month, then you're getting in at the highs and you're getting in at the lows. Okay, both Square and PayPal are extremely expensive right now on that price to earnings basis. But it might be over the next year or two, they might come down a little bit. They might come down 20% or even 30% in a stock market crash if that happens. But if you're investing every single month, you're buying the highs and then you're buying the lows. So it's a very stress-free, very easy and simple strategy for getting your stocks and over that long period. but not really the strategy you came to see, was it? It's not necessarily a way to play the market that's going to get you those higher returns, right? It's just going to get you the market returns and keep you in those stocks over time. So the other strategies are going to be a little bit more thoughtful. And first, I'm going to start off with the core satellite strategy, and that's something that a lot of you, anyone out there in the nation knows. Yeah, I'm a big believer in this strategy. I talk about this quite a bit. And this can be used along with that first strategy, along with regular monthly investing. But the way you do this is you pick maybe 5 or 6 ETFs, right? These are broad indexed, ETFs that hold hundreds or even thousands of stocks, bonds, or real estate. And you're going to put maybe 60 to 75% of your money in these 5 or 6 ETFs, right? And I've just got some examples here. But what you want to do, you want to get stock exposure. So here you've got the Dividend Aristocrats ETF, that NOBL. You've got the maybe the Vanguard Growth ETF, that's MGK. And those two alone are going to give you a broad exposure across stocks. It's going to give you dividend stocks. It's going to give you growth stocks. So it's going to give you a lot of the market, the stock market. Then maybe you have two other ETFs. I've got here the Vanguard Bond ETF, the BLV, which right now I probably suggest maybe the BSV instead. That's the short-term bond fund. This is a long-term bond fund. And so now the difference in bonds is that longer term bonds get hit harder when interest rates rise, right? And what we're looking at this year, of course, is interest rates are going up. They're going to be going up all year, most likely. And that's going to hurt these long-term bond portfolios, right? So you want to be in shorter-term bonds because the value of that bond fund isn't going to go down as much as interest rates go up. So maybe you have a 10 or 15% in a bond fund, and then another 15 or maybe even 20% at the most in a real estate fund, right? This Vanguard Real Estate Fund is one I hold. It's the ticker VNQ. And it's just going to, it's a fund of hundreds of real estate investment trusts, right? Real estate stocks. And with just these five ETFs, you've got that broad exposure into stocks, bonds, and real estate, all 3 asset classes. And it's really going to smooth out your portfolio. Then what you do with the rest of your money, maybe that 30% of your money, you invested in 10 or maybe 15 individual stocks, right? What this does is, you only got 10 or 15 stocks you got to pick, you got to follow. So it cuts down on the time you need to research. It cuts down on the time you need to track and follow these stocks. And you can really be selective, really be picky about which ones you're in for that next 10 or 15 years, right? So how this works is that you just put your money in each month and you divide it up among these maybe the 5 bond funds and 10 stocks. It really makes investing easy. You don't have to worry about it. You're going to get the market return from those ETFs, and you're going to get a little bit more upside potential from those individual stocks. Okay, so that's another strategy that you can use that is basically going to give you a little bit upside potential on the market returns, whether the market's going up or down. This next one is really playing the contrarian investor, and I love this idea. It takes a lot of patience though, and it takes a lot of a lot of strength, a lot of guts. Okay, and what this is basically is just each year you go into maybe looking at the sectors, maybe looking at individual stocks, and see what hasn't performed well, right? What has underperformed the market? Okay, because over time investors everything kind of goes in cycles, right? When tech stocks might be down one year and they're going to be up the next year because their value plays then. Energy is a great example, and we'll look at how to find these. But energy had probably its worst year ever in 2020. I think the energy select sector spider, that's ticker XLE, was down like 44% last year. Well, what's happened is over the last 3 or 4 months, it's become the top performing sector. So right, so if you had played the contrarian investor, and that's basically just kind of betting against the market, where the market sees weakness, you're betting on strength, right? And it's a little bit of that fearful when people are greedy and greedy when people are fearful idea, but you're actually being able to quantify that. You're actually being able to see where people are fearful and where they're greedy at. So what we're going to do here is we're going to go into, I'm going to show you how to find those stock sectors and that. And again, a lot of you out there in the nation are going to recognize this. This is the select or the the sectorspider.com, right? The sector tracker on that website. It's a great research tool that I've shared on the channel before, and I use it every day when I look to those sectors and the sector trends for the newsletter, for the daily bowtie. But this is a sector spider, so that's sectorspdr.com, and then you're going to go to tools and go to this sector tracker, right? And if we scroll down, we can see, over 1 day, 5 days, a month, all the way up to 5 years, how each stock sector in the economy has done, right, relative to the S&P 500 index. And with this strategy of being a contrarian investor, betting on those sectors or the stocks that have underperformed, you can go in here and see just that. So if we have this on a 1 year basis to see how the stock sectors did, and you can see, even after the huge gains energy has made. Okay, so I wish you could change this for date. I wish you could just look at maybe a certain date or a year for this, because you would see if we did that, maybe this is now. See, if we could just look at this on 2020 basis alone, you would see that energy select sector spider, that XLE, that energy sector here, was down 44%, right? So clearly weakness in the energy sector. And then over just this last 3 months, okay, it's up 28%, right? So what I'm talking about here is if you would have gone in, and we did this in our 2021 Bowtie Nation portfolio, right? In October, we loaded up that portfolio with energy stocks, with financials, with a lot of these stocks in the sectors that have done so poorly. And we're up 29% in that portfolio so far since October. We're beating the market by about 23%. And it's because I used this strategy. Okay, I played the contrarian, looked at what the market was selling on that annual basis, and then I bought stocks, the best stocks in that sector. Okay, this doesn't necessarily mean that you need to go in and buy. So the XLE is the Select Sector Spider Fund, right? The fund, the ETF that covers all those energy stocks in the S&P 500. That doesn't mean you need to rush out and buy that fund. You can look in here. So if we click over to energy here, and you can sort this by best or worst, but you can go in here and see which stocks are in that fund or in that group, in that sector, which ones have performed the best and which ones have performed the worst. So you could go a step further here and not just say which sectors have underperformed, but which stocks within that sector have underperformed as well. So we see stuff like Occidental Petroleum, Apache Corp, Kinder Morgan, which I love Kinder Morgan right now. I've actually loaded up on shares of Kinder Morgan in my own portfolio. Rich Kinder, co-founder of it, has upped his stake to like 11% of the company. He's buying up that company back. And it's done really well over the last couple of months. Schlumberger, a lot of these oil explorers and that. You can look at ConocoPhillips. Diamondback Energy is one that we've got in our 2021 Bowtie Nation portfolio. That stock is up 120% since October, since adding it to the portfolio, because I looked at this. I looked at the energy stocks and how badly they did in 2020, and it was just obvious that with the economy rebounding, then these energy stocks were going to get a second life. So you look in some of these other ones. Okay, so we've got utilities here, and while I'm not a huge fan of utilities this year, just because interest rates are rising so quickly, that tends to pull people out of utility stocks. Okay, right? If a lot of people are investing in utilities because they have those higher yields, right? They have yields of 3%, 4%, and 5% dividend yields. And they're fairly safe. But if interest rates keep going up, then people are going to look at bonds. People are going to look at safer bonds and even treasuries and say, okay, why do I need the risk in utility stocks if I can get a comparable return in a treasury bond or even a safe corporate bond? So generally, when interest rates rise, these stocks in the utility sector do poorly. But it's hard to ignore the fact that over the last year, utilities are down 12.5%. Right, so maybe you want to look in here and see some of the really strong utility stocks, some of the really strong utility companies, where that value is at, and add some of those to your portfolio on that contrarian basis. Likewise, if you're looking for shorts, if you're looking for things that maybe you want to sell, you look here, and technology, obviously, and industries within technology have just boomed over the last year. Communication services, consumer discretionary. So a lot of these, a lot of these sectors that have done really well over the last year, maybe it's time to start lightening up on those. If you think the market is expensive, if you think the market's expensive and you're worried about a downturn or worried about a correction or even a crash, then maybe you start lightening up on some of these sectors that have done really well already. So that's just going to be that's going to be the third strategy there. Just constantly playing the contrarian, and that doesn't mean every month. Okay, that means maybe every 6 months, right? You go back, you check, you check that select sector spider, that spider. Sectorspider.com for the sector tracker. You track those sectors, see what they've done over the last 6 months, and maybe you adjust your portfolio a little bit, or maybe you just put new money in these sectors that have been beaten down. It doesn't necessarily mean you have to sell everything out that you've got up to that point, or to start selling those sectors that have done really well. Maybe it just means that with your new money that you're putting in every month, then you start putting it in these stocks and in these sectors that haven't done so well, that maybe are better value plays right now. Okay, so now this fourth theme that I want to talk about is really just betting on those universal themes and going with the best of the best stocks within that. And this is, again, something like we're talking about in that big ideas report for the ARK Invest report. Just going in and looking at, okay, what's going to be the next, what are the trends over the next decade, over the next 20 years? Okay, like we said, love PayPal and Square right now. But both have gone up, really, I think, doubled over the last year at least. And those are fairly large companies. Some other companies in that space have even tripled or more their stock price. So undeniably expensive. But what you're looking at is a theme, a universal force that is just changing the way we work in this world. And thinking, okay, even if stocks do come down 30%, 40%, even if some of these high-flying stocks come down even more, over the next 10 years, you're going to be very well off by putting your money in them, okay? Again, with that example with fintech stocks in the digital wallet space, ARK invests that there is a $4.6 trillion opportunity in those stocks. They estimate that got some Hell's Angels passing by the window or something, I don't know. But anyway, ARK Invest estimates that each digital wallet user, right? And that's just a way of saying an online bank user, right? Someone with an online banking account. Each one of those people could be worth up to $20,000 each, right? And right now they're saying that investors are valuing PayPal, for example, has its Venmo app, right? As a digital wallet you can use to pay for stuff. They're saying that it's valuing those customers in that Venmo app at just like $200 right now. Okay, so even if PayPal on its current earnings is relatively expensive here, if it can get those that valuation of those 70 million people using that digital app, that digital wallet, if it can get that to 20,000 each over the next 10 years even, ARK believes that digital wallet users can double over the next 4 years to 2025. But even if it takes 10 years to get the valuation of those users up to $20,000 each, that is, that's something like 6 times or more the current valuation of PayPal. So basically, you're looking at these universal themes that we're talking about in that Big Ideas report that we talk about on the channel. Those big, those decade-long trends that are changing everything, and you just invest in those. You're right, and you really don't worry about the valuation. Okay, and I know that's hard to do because as the valuations get higher, you get that risk of of a sell-off, and it sucks to lose 30% of your portfolio or 30% in a stock. But if you can have that faith in that longer term theme, you're still going to do very well. Okay, I'd take a 50% loss on a stock right now if it meant over the next 10 years I would make 6 times my money on it. Okay, that's just how it is. I'm a long-term investor. I can take a little bit of short-term pain for that long-term reward. Okay, so that's really the fourth strategy here. And now the fifth strategy, before we get to our question and answers, is going to be a kind of a cash secured puts idea. And this is something that I've talked about in the on the channel a couple of weeks ago, and just a great way to get in on your stocks at a discount, right? And I'm going to explain what that means. So here we've got CRISPR Therapeutics, right? It's a kind of a gene editing company, right? ARK Invest owns this company. I own the company. I own shares. And basically they're just using gene editing technology to detect cancer, to for therapies. This is the next thing in medicine. Okay, this is going to be huge, and we will cover that in one of our big ideas video. But it's expensive right now, right? We can look at the chart here, and over the last year, even after coming down some, it's come down since January 14th. It hit $210 a share. It's now down to 150. So that's that's a pretty big sell off there. But even after that sell off, it's still up 300. It's still up 200% over the last year, right? That's up from about $50 a share, $150 now. So up threefold, about 200% over the last year, and still a little expensive, on that price to earnings, even price to earnings to growth ratio, it's still kind of expensive. But it's another one of those ideas in that universal themes that we talked about just now, that stocks that you want to be in over the next 10 years. So what I can do is, if I'm worried about that stock being a little bit expensive, right? If worried about investors still being a little greedy in that stock, then I can go to options, and we're just using Yahoo Finance here, but you can use this on any investing platform. I use E-Trade and Webull to do all my options investing. And what you can do is you can go. I usually use the January options, so we'll go January 2022. These options will expire in January of next year, and you've got calls and puts. And I did an options trading video about a month ago that explains how to use options, how to trade options, and 5 option strategies that I use. But this cash secured puts one is basically just a way to get in on stocks at a discount. Okay, what you've got here. So I can go in here and sell the put options for the $150 put options. Now this gives someone else the right to sell their shares of CRISPR to me for $150. Right? They buy that right to exercise anytime between now and January of next year. If they want to sell me those shares for $150, they can, because I've sold them this put option. Okay. Now what this means is that they're paying me about $50. It's actually $51.66 right now to have that option. Okay, so I'm going to sell them this option for $51.66. They're going to give me that money, and then over the next year, if they want to sell me that stock for $150, then that's the price I have to buy from them. But if you think about what that means, is I'm obligated to buy that for $150. Okay, minus the $51.66 they just paid me per share. So basically, I'm going to get, if shares stay below $150 each, then they're going to sell me those for that amount. But accounting for this money that they paid me, I'm basically getting the shares for $98.34. That's my cost basis on those shares, which right now is a discount of 33%. Right? Yeah, I'm getting the shares for a third of their current value. Okay, so the strategy is, and of course, if the shares stay above one or go above 150 and stay there, they're not going to sell me for that amount. They're going to just sell their shares in the market or keep their shares and not worry about it. And I keep that $51.66. Okay, I keep the premium that they paid me for those put options. And so what this means is, I mean, it's a win-win situation. If I wanted to invest in this company anyway, okay, if I was looking at shares of CRISPR to pick up and hold in my portfolio, then I would have had to pay $148 right now for those shares. With this strategy, though, I can get them at a 33% discount, or I can just keep that $51 per share. So it does kind of limit your upside, a little bit. So I mean, I'm going to hold the money in my account to buy those shares if I need to. So right now, if I collected that money, but I held the $150 per share just in case I need to buy those from now until January from that investor, but that's still a 34% return. 34% return in less than a year, in 11 months, is pretty darn good, And if I do end up not getting the shares, I just keep that money and keep that 34% return. Then I can buy the shares if I want them, or I can do this strategy all over again either collect the shares or collect another 30% return next year. So it's a great strategy when you're not sure if the market is kind of expensive right now, or if you're not sure that an individual stock is too expensive. You can sell these puts, sell these put options, keep the money in your account to buy those shares at that put price. If you need to, but you get that instant premium that you collect, and you get the shares at a steep discount if they do end up trading below that stock price. So 5 strategies that you can use that are great ways to actually have a formal strategy to when to invest and how to invest. It's not just saying